Hello and welcome. In this video, we'll take a look at how to use the IRR concept to evaluate a cash flow when you're borrowing money as opposed to actually investing. So when you're borrowing money, you typically have an initial negative cash flow or initial positive cash flow followed by a set of negative cash flows. And in this example, let's say you want to purchase a car and you want to borrow, you have the option to borrow let's say $5,000 from a dealer, and you can repay at the rate of $2,000 every year for the next 3 years. So let's just plot those cash flows. So initially you borrow $5,000 and then you repay $2,000 every year thereafter. And I'm just going to copy it like this. Now, the other alternative is that you can borrow this $5,000 from a bank at 9% interest rate. So you want to see if it is a good option to borrow the money from the car dealer or borrow it from the bank. To do that, we will compute the internal rate of return for these cash flows, IRR, and I'm just going to select all of them and give us 10% guess rate. And what you see is there is a 9.7% internal rate of return that applies to these cash flows. Now, is that good or bad? Now, if you were investing this money and you were earning this money at the end of various years from your investment, then your 9.7% is greater than, let's say, the money that you would earn in the bank, which is 9%. But so it would be good, but in this case you're actually borrowing this money and repaying this money in the next 3 years, and your internal rate of return is higher than the bank interest rate. So this is actually bad for you. So actually borrowing money and on these terms from the car dealer is actually bad for you because its internal rate of return at 9.7% is higher than the interest rate that you will earn by borrowing from the bank. And to see that, let's estimate the cash flow from the bank. And if you were to borrow this money from the bank, you would borrow 5,000 in the beginning. And I'm going to use the PMT function to estimate how much you'll pay on an annual basis. The interest rate is 9%. The number of periods is 3 because you're repaying in 3 years. The present value is what you borrow initially. The future value is 0 because you intend to repay the full amount. And the type here, we want to say 0 because you repay these dollar amounts at the end of each year instead of at the beginning. So I'll put it 0 again and complete the parenthesis. So you will be repaying $1,975 every year if you were to borrow at 9%. And just so that we can copy this further down, I'm just going to apply the dollar, absolute cell reference by, I just click on that particular cell and press F4, and I click here inside B1 and press F4 again, and that will result in the cell references being absolute. And from then I can just copy this further down like this by clicking and dragging the fill handle. And you can see that each year I pay $1,975, which is lower than the $2,000 I would pay with the car dealer. So that gives us further confirmation that borrowing from the bank is a better option. Another way to look at this is to compute the net present value of the dealer's, of the cash flow, of your cash flow when you borrow from the dealer at a 9% bank interest rate, and you will see that it will be negative. So equals 5,000 plus NPV of the bank interest rate and these cash flows, and you can see it's actually negative. Now, another way to look at this is to compute the internal rate of return of the bank cash flows, and it will be exactly 9%. It'll be exactly 9%, and the net present value of this at the bank interest rate will be 0. It is 0. So all this confirms what we are saying. So the essence of this concept is that if you are evaluating a loan to yourself, then your internal rate of return should be lower than or equal to what you can get, the interest rate you can get from an alternative source such as a bank.